All right, everyone. Thank you very much for joining us today for another great educational webinar we're putting on. We're going to be focusing on rehabs and rentals in an IRA and some of the benefits and drawbacks to each, and as well as a few different ways to structure things. I'm on with my colleague Larissa Greene today. We'll get started here in just one moment. Larissa, if you can just go ahead and now try and see if you can advance everything. Just double check.
Go up to show your screen, Alex, because I don't see the slides.
Oh, you don't? Okay. Let's see. Sharing. All right, we should be good now.
Yep, perfect.
All right, see if you can take control. All right, looks like we're good.
Yep.
All right, cool. Well, with that said, we'll go ahead and get started. Just remember that if you are on the webinar today, your audio is muted, so please do type into the chat box and we'll go through the questions as we get them throughout the presentation. With that said, we'll go ahead and get started because we are kind of up on the top of the hour. My name is Alex Perny, my co-host today, Larissa Greene. I've been with Advanta since about 2012. I started my career in self-direction and handling client investments and actually processing different things related to different deals people were doing. So I have a lot of experience based in the actual transactional part of doing IRAs and the different ways that people have done stuff. Seen a lot of rehabs, see a lot of people doing rentals and all sorts of other things in between. So again, want to make sure that that is used as a resource for everyone. If you do have any questions, Larissa or myself, we both have a lot of experience in this. We can certainly take care of that. My contact information is up there as well. Just also want to notify people that the handout that's attached here today is a PDF copy of all the slides. So if you do want a copy for future reference or would just like to have a copy for your file, feel free to grab those. But if you don't manage to grab them, both Larissa and myself have copies we can email to you as well. With that said, I'll turn it over to Larissa to introduce herself, and she'll take you through the front half of some of the basics on self-directed IRAs and things like that. Larissa?
Thank you, Alex, and thank you everybody for joining us today. As Alex said, my name is Larissa Greene. I've been with Advanta since 2011, so Alex and I started just one right after the other, and so we've been with Advanta a lot of years. We have a lot of experience with self-directed IRAs. I started doing back office work, including transactions, check coding, and new accounts, transactions, and transfers. So we've kind of done all of it. As the business has grown, we've moved to more specialized roles as new accounts and business development, marketing, and education. And we are both teaching classes every month and sometimes every week, just depending on what our schedule looks like. So thank you again, everyone, for joining us. And Alex did mention that you can type into the chat box any questions you had. I recently had somebody say they weren't sure how to do that. So if you look at your control panel for GoToWebinar, it's typically on the right-hand side of your screen. You'll see a box that says questions. If you click on that, there's an opportunity to type into the question box. Just go ahead and type your questions in there and we'd be happy to answer them for you. Something that we do not do is provide legal, tax, or investment advice. So a lot of times if you join our webinars, you'll know that we do talk about the rules for investing and different strategies that we see. But if you do have a specific question and say, am I allowed to do this? Is this business structure going to work within my IRA? We may be able to answer that. But if you say, is this a good investment? Is this a good return? We can't answer those types of questions. We also can't answer different tax and investment advice, but please go ahead and do still ask it, and we may be able to refer you to professionals who have assisted our clients in the past. A little bit about Advanta. We are a self-directed IRA administrator, and what that means is that we help you with the account, we hold the account, but you find the investment and we help you get it done, and we can help clients with this service nationwide and potentially even worldwide. So we do have clients that live overseas, but they do have a US-based retirement account, and so those accounts are still eligible to be self-directed, and so we have clients all over the map. We are located here locally where Alex and I are in the Tampa Bay area of Florida. And this is sort of our corporate office, if you will, here in Largo. But we also have an office in Atlanta, Georgia. That's more of a marketing office where we have associates located. And they hold lunch and learns and seminars just as we do. And again, we can help our clients nationwide and even worldwide. All of our clients do get a dedicated account manager, and that person is with them for the life of the account so that they know who to reach out to for anything from making investments all the way through to making contributions to their accounts. So that's a little bit about us. And also as well, we have been in business for almost 20 years. So next year will be our 20-year anniversary. And we have a little over $2 billion in assets under management. So if you've been with us as a client for quite a while, you know that we have grown over the last 20 years, and it has been an awesome thing to see. So let's get into sort of the definitions and things that we're going to be talking about today. So what is a self-directed IRA? A lot of times Alex and I meet people who say, well, I have a self-directed retirement account with my brokerage firm and I'm allowed to choose investments through that account. Well, the truth is that you can choose investments through that account, but it's all going to be assets that that brokerage firm is selling. So anything market-based that they will hold, that they're willing to hold, that is kind of what their definition of self-directed retirement accounts is, but our definition is much broader. We're talking about privately held investments, anything outside of the market, and anything allowed within IRS rules. And so that is really what we're talking about when we talk about a self-directed IRA. And so many of you know real estate is the #1 investment that we see through a retirement account, and that might be buying and holding real estate. That could be holding notes and mortgages and deeds of trust through the retirement account. It could also be things like private placements that are based in real estate. But we also see a myriad of different investments as well, like precious metals, foreign currency, futures trading, cryptocurrency, of course, is something we see a lot, or investments outside of real estate that might also be considered private placements. So investing in a private placement, for example, that is based on startup businesses or growth for companies and things of that nature. And really, the sky is just about the limit for a self-directed IRA. So I always tell people, we could all name an investment, and it's very likely that you could do it through a retirement account as long as you're not doing anything that would be considered prohibited. And Alex will talk about that in just a minute. So why haven't you heard about a self-directed IRA? And again, I know a lot of you are joining us for this webinar and you join us pretty often, but if you're new to Advanta IRA and the idea of a self-directed retirement account, just very generally, there are not a lot of companies out there like Advanta that will hold private investments. Brokerage firms consider them hard to value assets and they're unwilling to accept interest income for a mortgage or a rent payment. They don't want to help you pay bills on behalf of a rental property or a rehab project like we'll be talking about today. And so they've made it a business decision not to hold these investments. And so what we've done is really just the opposite. We're filling the gap in the industry to hold private investments. And so we don't actually hold anything market based. Everything that we hold is going to be considered private, and that includes things like private stock. And really less than 4% of all, and we have IRA investments, but truly retirement accounts in general, including things like 401ks and 403bs, are truly self-directed. And I always think that is interesting because as the number of retirement accounts out there grow, and the number of people that self-direct grow, it really doesn't necessarily change that percentage all that much. It hasn't changed much over the years. So what types of plans can be self-directed? And a lot of times when I talk to people about self-directing their retirement account, they'll tell me, well, I don't have a Roth IRA, so I can't buy real estate, for example. And I'm not really sure where that comes from, but I do hear that pretty often. And the truth is, if it ends in IRA, it can be self-directed. So that could be a traditional or Roth IRA, of course, a simple IRA, or a SUP IRA. All of those plans can be self-directed. A traditional IRA is the most common account that we open. I think that's probably because a traditional IRA is often funded by a rollover from an old employer plan. So once you leave your employer, you sever ties, then you have the ability to roll that plan into an IRA so that you can move it where you like. And that is typically going to be considered a pre-tax rollover. And so it would just simply go to a traditional IRA. And I think that's why we see those most often. Up here, we also list former employer plans, and I just sort of described what that looks like to you, basically just taking that old employer plan and rolling it into a new retirement plan, and that could be a traditional IRA, but it could be any number of the ones you see up here listed as well, just depending on what you're looking to accomplish and what makes the most sense for you. We also have health savings accounts up here as well as education savings accounts. The rules for self-directing those accounts they're exactly the same as IRAs, and so we can hold those accounts for you. We can help you self-direct those plans as well. So if you're looking for a health savings account or an education savings account, or you would simply like to learn more about them and the possibilities that they allow, just let Alex and I know. We do have webinars on health savings accounts specifically, and so we can certainly share those links with you. So why do people choose to self-direct? Well, very simply, it's a new source of capital that they can access for their investments. Many people didn't know about self-directed IRAs. They come over to us and they say, hey, I didn't know that I could do this. I want to get invested in real estate, or I want the opportunity to invest in a limited partnership, or I want to lend money, and I didn't know that I could access the cash in my retirement account to make those investments. So once people find out about a self-directed IRA, they're typically looking to put that money to work in something maybe they know better than the stock market. Of course, and we're all sort of experiencing this now, is stock market fatigue. They're sort of tired of the investments in the market, the up and down that the market takes at times, and not having tangible assets, for example, in their retirement account. And so when you go to a self-directed IRA, you have the opportunity to invest in something that we consider, tangible. You can drive by it, look at it, see it. It's still going to be there. So even if the real estate market values go down, it's still an asset that's tangible that you have in a retirement account. And then, of course, the tax benefits. So making those investments and having those investments grow tax deferred or tax free, depending on the type of retirement account that you have. So real estate options, what choices do we have? And so as I mentioned, we could probably all come up with a structure for your retirement account investment that you're looking at doing. And it's probably possible that you can do that in a retirement account. But here on this slide, we have listed the most common investments we see for real estate. And we'll be talking about some of these going forward, but of course, buying and holding property or rehabbing property. So just very basic, purchasing a piece of real estate and making a decision as to whether or not you're going to hold it long term or rehab it and sell it. We also have joint ventures. Pretty commonly, we see lending money with some percentage of the upside for some reason or another. Borrower and lender come to an agreement and they put a joint venture agreement along with that lending opportunity. We see option contracts for real estate, and I would consider this sort of more of an advanced strategy. And so if you're not familiar with options, we do have webinars that are based around options where we have invited longtime investment professionals to join us and talk about option contracts and how they work in real estate. But we do see those in a retirement account. So making an investment and agreeing with a seller that you're going to buy a property at some point in the future for a set amount and earning the upside on that investment. That's what an option is. Syndications, of course, when people are raising capital for a specific real estate investment. And so they might be, for example, buying an apartment complex and they're raising capital for that investment. And so they invite other investors to come in passively so that they can raise the capital they need for that investment. That would be considered a syndication. And sometimes those are also considered limited partnerships. The syndication is usually based on a specific deal, and limited partnerships may have many deals. It just depends. Tax deeds, of course, purchasing real estate through tax deeds, and of course tax liens, private lending, and the list really does just go on and on and on. So you'll see a lot of these investments when we talk about the rules and things of that nature throughout our webinars. And if you have more questions on those assets, please let us know. So finding the deal, how do people typically find the deal? And a lot of times it's just strictly through networking. So joining your local, what we call a RIA group or a real estate investment association group. They're all over, they're nationwide, and there is a national RIA, and then there's smaller groups that branch out from there. And of course, networking with those people and maybe finding out what groups they attend and where they like to network will help you find the seasoned investors in your area and then possibly deals from there. And of course, Advanta IRA has its own networking group every other Friday, and it is this coming Friday. So if you haven't joined us for those, it is a Zoom call where everybody has the opportunity to pitch an investment, talk about what they're looking for, or pitch services they provide, and that's every other Friday. It is an open forum. You could go to advantaira.com/events and find our event titled Pitch, Promote, and Prosper and register to join us for that event. You'll have the opportunity to hear from investment providers or people that are looking to place capital as well. Moving money to a self-directed retirement account is very easy, and we like to include this slide because a lot of times people are fearful to make the transition because they think there is a taxable event involved, and the truth is it moves seamlessly from one type of account to the other, and as long as the accounts are treated the same tax-wise, there is no taxable event generated from a transfer or a rollover. And sometimes even an indirect rollover. And I'm not going to talk about that specifically today, but just keeping in mind that as long as money is moving directly from one type of account to another, you're avoiding any type of tax burden with moving those monies. So moving from a traditional IRA to a traditional IRA, again, there's no taxes paid. If you're moving from an old employer plan to an IRA, you have the opportunity to do that without paying taxes. Moving a pre-tax account to a traditional IRA, for example, again, just seamless, no taxes or penalties are paid. And so you don't really have to remember how to do it or the specific definitions, but just know that as long as you're moving from like account to like account, you're not going to pay taxes and penalties for doing so. And when you make investments in these accounts, you are not borrowing the money. That's a question I get a lot. Well, how long do I have before I have to pay the money back? It is not a loan. This is an investment of the retirement account. So when, for example, you're buying rental property, we're going to help you with that specific titling that shows this is an asset of the retirement account, and therefore it is not a loan to you, which actually would be prohibited. So I'm going to turn over this seminar now to Alex, who's going to talk about the rules and how investing within the rules works through a retirement account. Alex?
Yeah, thanks, Larissa. Yeah, definitely some great points that are brought up by Larissa. Just to kind of reiterate, the biggest thing that I always like to make sure people take away from that front end section is that no matter really what kind of retirement plan you have, there are options out there available to you. Whether that is something based in real estate, whether you have a Roth IRA, traditional IRA, an old employer plan, thrift savings, all those different kinds of plans out there can be utilized in this fashion. So, just looking through the attendees, we definitely have some people that understand this, but it's something that, again, maybe a little bit, on the more basic end of things, but for anyone out there, I want to make sure it doesn't miss anyone that is really kind of one of the cool things about this is that, you're not just kind of dropped into one particular bucket. There's a lot of different things that can work for you, and the best thing you can probably do is give us a call to see if there is a workable solution for you if there's something like this you're looking to do. Before I get too far into the weeds on the rules, I have a question coming up here. Let's see. My son is on the call with me, and he has yet to start an IRA. He would like to start an SDIRA with Advanta. Can he fund it with ongoing contributions? The answer to that is absolutely. There is definitely not a problem with utilizing contributions to start. You don't necessarily have to have any type of pre-existing plan to roll over one of these things from. You can definitely use things just like contributions. So your $6,000 or $7,000 contribution annually can certainly be used to start with this. And just one other quick question before we get started. What are the real estate investment networks called? They're called REIAs, REIA. If you just kind of go on and search, let's say just your local city and REIA, you will come up with a litany of different groups that you can go and join. And again, some are better than others. I would say try a few, see which one is just right for you. Go out and try. It's if at first you don't succeed with these, believe me, there are a number of different ones out there, and probably many in your local group through that. So again, I see some other questions coming in. We'll get to those. Just keep on typing those in. We didn't miss you, but we just want to make sure that we get through the content so that way, respect everyone's time and try to get y'all out of here at the top of the hour. So while there are a ton of different options out there for investing with self-directed IRAs, there are some rules you do need to follow. And basically, so long as you can kind of grasp these high-level rules, I would say probably 95% of all of your issues can typically be ameliorated with these. You're not going to run into too many things past this. Granted, there are some nuances to these, and depending on what type of deal you put together, it's always good to kind of run the scenario by us first. But the general rules you need to understand is that there's a few things you cannot directly buy with an IRA. You can't buy a life insurance policy directly, and you can't buy things that derive their value from collectability. So life insurance is easy enough to kind of grasp. Collectibles is, again, a little bit more nuanced. So you can't buy things like rare bottles of wine, artwork, baseball cards, Pokemon cards, all these kind of things, that may certainly do have value. You can't use your IRA to purchase. It has to be something that's based on a more traded or marketable value. Now, certainly you could say, well, the scarcity of real estate is what drives its value up. Yes, but you don't treat real estate as a collectible. Again, there is definitely some leeway in what those things are, but just paint with a broad brush and think of, house not collectible, artwork collectible. You can kind of see that clear line right there. Now, again, some coins are allowed. You can invest in things like gold, silver, platinum, and palladium, and certainly those are sold in coin format, but you have to be buying those based on the actual content value of the coin, not necessarily the numismatic value of the scarcity of the coin. So, a Morgan dollar certainly has much more value than its gold content. You're not buying those with an IRA. Buy a newly issued gold American Buffalo, gold Eagle, something like that. You kind of get the idea with that. Now, prohibited transactions is where kind of definitely some more of the nuance is going to come into this. There are certain people that you cannot directly deal with and from, and I'll put the slide up there in a minute, but those are people called disqualified persons. The IRA owner is considered a disqualifying person from receiving a direct personal benefit from their IRA-owned assets, and we'll kind of definitely, we certainly will definitely get more into what that means in the context of renting versus rehabbing when it comes to who can do work, who can actually make a benefit from this, because those are very important things. While they're very easy to maybe understand, they definitely are some things that you need to very clearly focus on when it comes to actually making the investment and the ongoing administration of the asset, and also depending on how you actually structure things as well. If you want a more detailed analysis of this, Internal Revenue Code 4975, 4975, 4975, you go to irs.gov, search it in that box, it'll pop up. It's not the easiest thing to get through, but it kind of lays it out pretty clearly. What I would tell anyone, if you have an idea for an investment structure, give Larissa or I a call. Use our almost 20 years of experience to kind of figure out, hey, is this a workable solution? If not, is there something that we can change to make it workable? We've seen a lot of it. We can definitely help you out with it, because believe me, you're not the first person to probably ask us the question, nor will you certainly be the last. There's a lot of stuff that goes into it. Something that I'm not going to go too far into, though, is things related to unrelated debt finance income tax and unrelated business income tax. What I really like to kind of broadly hit on with that is most people are familiar with real estate in the context of you buy real estate, you get a loan for part of it, and you put a down payment on it. When we're talking about buying real estate for IRAs, the majority of the time we're talking about the IRA purchasing the investment cash. So there's not going to be any type of underlying debt with the property. The IRA is going to be making it the purchase as cash. You certainly can finance within an IRA to buy property, but you are going to be exposing the IRA to a partially taxable situation. And again, most people, with the whole nature of utilizing a tax shelter like an IRA, want to try to avoid that. So the 30,000-foot view of avoiding these really kind of specialized taxes of UBIT or UBIT or UDFI, which is the debt portion of that, is to buy properties cash. If your IRA doesn't have enough money to buy something cash, partner with a couple of people to make the deal work as cash. So there's definitely some ways to avoid that. But again, it's just certainly something to understand. Understand that it's out there. And it's definitely, again, I kind of keep circling back to this, hate to sound like a broken record, but call and ask. We've seen this play out a lot of different ways and can certainly try to help you, try to avoid some of these things. So there are ways to avoid it, but on a very basic level, if the IRA has to borrow money to make a deal work, which has to be a non-recourse loan, then there would be UDFI that's going to apply in that scenario. So that's the basics of it. If you want to try to avoid those types of things, make the deal work cash, and you'll be more or less set. A couple of questions we got in here. Let's see. Can you add partners to an LLC? Yeah, we're going to get into how the basics of what people like to call checkbook control, but you don't necessarily have to buy properties directly in the IRA. The IRA being listed on title, the IRA can form, let's say, a partnership or some type of LLC where partners come in and bring their cash together. So that way you don't have a deed title being chopped up between like 6 people as a tenant in common. You can have one LLC with multiple partners that then in turn purchases the real estate. And not all of those partners have to be IRAs. There could be people using their other LLC funds or trust funds or taxable individuals coming into that. So you have a lot of discretion and variance on how you can do that. Again, I always kind of circle back to the point, there's a lot of different ways to do this. We're just going to be kind of covering some broad investment strategies with rehabs and rentals today. But the way you do this, the way you structure these deals can vary a lot. Let's see. Do the same rules apply to a Roth IRA? Yeah, when it comes to UBIT and UDFI, they apply to any type of account. It does not matter what type you have. And as far as audio goes, I see some people saying everything looks good on my end. Says my audio's just fine. So I'm not sure what's happening there, but we will continue on. So disqualified persons. This is, again, for a visual representation, the people that you cannot directly deal with. So if you look at your family tree, mother, father, son, daughter, spouse, directly up and down from you in your family tree. However, if you go laterally in your family tree, you could buy or sell something to a sibling or an uncle or an aunt or a cousin or someone like that. So just because the immediate nuclear family of yourself is disqualified from buying and selling to doesn't mean other people out there aren't available to do deals with. Now, even though these are disqualified individuals, meaning that you can't directly buy or sell something from one of these people also cannot do work on an IRA owned property. So let's say your son owns a landscaping company. Your son can't come do the landscaping of your new rental property. Or let's say your parent owns a construction company. They can't come in and, let's say, put on a roof or redo a floor plan for an IRA owned property. So you have to kind of make sure that you keep this stuff at arm's length. And that's a very good guiding principle, is to understand that all of these things have to be done at arm's length from yourself personally. Now, we're not going to necessarily get into it in this presentation, but you do have the ability to potentially partner with these people. So if you're married, you and your spouse could potentially your spouse and yourself could partner IRA funds together to purchase something. You could partner personal funds potentially to invest in some type of deal that you have going on. But when you do that, it definitely adds a little bit of a layer of complexity to things. It's not something that I would maybe recommend someone do on their first attempt at this. If you do have to do it, again, sound like a broken record, give us a call. We'll walk you through all the different types of pitfalls and different things you need to look at. But back to disqualified persons, directly up and down from you in your family tree, can't do the work, can't directly buy and sell something from. Once you get outside of that, brothers, sisters, aunts, uncles, cousins, you can deal with all these people. However, if you are going to be dealing with family, one, I'd recommend that you always make sure you do it on a fair market value basis. And two, understand that when you're dealing with investments in family, if things go sour, you're going to have a really awkward Thanksgiving dinner. So maybe not always necessarily dealing with family is a good idea. Again, everyone's tolerance for this kind of stuff is your own. But again, if you're dealing with money, especially retirement funds, erring on the side of safety and caution, probably not the worst way to go about things. Now, what do what do prohibited transactions look like? They can come in a lot of different forms and fashions, and not all of them necessarily crop up in the very beginning of things. So one thing that would essentially be from the very beginning prohibited, an IRA purchases a piece of real estate your son, tries to purchase a piece of real estate that your son owns. Can't buy something from a direct lineal descendant or ascendant of you personally, so that one's directly off the table. However, let's say your IRA owns a piece of real estate. You couldn't lease it out to your daughter. Just a quick example, when I was doing transactions for clients, I was provided with a lease agreement for a gentleman who had purchased a piece of property in Auburn, Alabama. What's in Auburn, Alabama, but the University of Auburn? Yeah, I think you can probably see where this is going. We received a lease agreement that had a couple women listed on it, and one of the women had the same last name as the client. So I asked, hey, who is this person? He said, oh, it's my daughter. She's going to, University of Auburn starting in the fall. Well, the purchase of the property was not an issue, but leasing the property to his daughter, even if he was charging her fair market rent, is disqualifying. One of those people cannot utilize the property that your IRA owns. Something else, your father's IRA, skipping a generation, lends money to your son personally. that again would be disqualified. So even maybe you're not necessarily in it, but something's skipping a generation. It doesn't matter if it skips generations, if there's great grandparents or great grandkids. IRAs in that direct lineal descendant and ascendant line are disqualified from directly dealing with those kind of things. Let's see. Oops. Your IRA purchases real estate and hires your son or his company to perform the rehab work. Kind of mentioned that. Should be fairly self-explanatory. Service providers are included with the disqualifying prohibited transaction rules. Now, let's say you are interested in financing a portion of a property. Again, we're not going to get too far into the rules on debt finance within IRAs, but let's say your IRA makes a down payment for a property, but you offer a personal guarantee on the mortgage. That does disqualify it as well. You have to have non-recourse financing when you borrow money in an IRA. The IRA would have to be named as the lender. You're giving no other recourse or personal guarantee. What exactly does that mean? If it does sound complicated to some of you, essentially what that means is that the lender has to only lend on the property deal as it sits. They can't take any other cross-collateralization of your personal assets or your personal creditworthiness into account. If the deal goes bust, then the only thing that they can come after is the underlying security, which is the property. Now, these types of loans, which are called non-recourse loans, are not something that comes up a whole lot in residential real estate. It's going to be mainly things that are focused on commercial real estate. With that said, there are certainly lenders out there that will lend you money to an IRA on property. You just have to know where to look. And again, we want to be a resource. We're happy to provide some of that information to you. Or in another scenario, let's say a spouse's IRA owns a piece of real estate and wants to sell your IRA a portion of that property. So you can't split something up. The rules don't have to do with whole sales of pieces of real estate. It also covers partial sales. However, in that same scenario, if you had maybe partnered with your spouse or yourself personally in your IRA funds, that deal might have been able to been accomplished. Whereas after the fact, you can't split it up, after the ink is dried on the deed. So again, there are ways that some of these things can kind of be backed into. There's some of these things that maybe would be allowable if you had structured things a little bit differently from the onset. But it's important to understand that mainly these things are going to be focused on whom you are dealing with when it comes to the actual IRA, meaning personal involvement or familial involvement. If you can kind of cut those things out of your IRA dealings, you're going to, again, avoid a lot of the issues here. I got a question. I think it's probably a pretty good one in the context of what I just said. If a joint IRA investment in a rehab, the spouses has more money in the investment but does not manage or rehab, can each get an equal financial benefit? No. So essentially what I believe you're asking is that if you have partnered into a real estate deal, and let's say the spouses both use their IRAs, one has 100,000, the other let's say has 200,000, their benefit and also expense ratio is going to be based exactly on how much money they put into the deal. They can't get it equally, and it can't be weighted one way or another. It has to come out exactly equally for there to be no issue with IRS rules. Let's see. Can one transfer from a traditional IRA to a traditional 401k and then backdoor it to a Roth 401k? In the context of that, yeah, but there really isn't a need to do that. You can roll over funds from a traditional IRA into a 401k, but you can do an in-plan 401k conversion. There's not a problem with that. There's really no need to kind of do something like that per se. Let's see. Can you go backwards one slide for the lineage? Sure. Can your family volunteer to work or rehab on a property? This wouldn't be done for money. No. Any of these people that I got listed up here, you cannot do that kind of stuff. They can't be involved at all. It's the short and skinny of it. Can't be involved at all. Can't directly deal with them. Work doesn't matter if it's free or sweat equity. Just can't do it. Unfortunately, it's not the answer you're probably looking for, but at least it's an easy answer. Now let's see. All right, let's keep on moving. Okay, real estate assets. Now, one of the nice things about self-direction is there's not one prescribed method for doing this. And again, we're going to cover two different avenues you can go through today, rehabs and rentals. But that doesn't mean that you're necessarily constrained to just those two types of deals. You can do all sorts of different cool stuff. And believe me when I tell you, we have seen a lot of cool stuff here at Advanta. It's really amazing to see just how people get creative with making money. If you're familiar with maybe one niche segment of, let's say doing short-term rentals or tiny houses or any other type of interesting, quirky real estate deal, you can do it with an IRA. If you like the chocolate and vanilla varieties of rehabs versus rentals, you can absolutely do that too. But the important thing I want to hammer home is that you're not constrained. Again, we offer unlimited options to our clients, asterisk being has to be done within the IRS rules. But the IRS doesn't prescribe a certain method for doing this. So you can buy single family homes. It can be a long-term rental, short-term rental, rehab project. You can buy condos. We see a lot of people really going hard with mobile homes and mobile home parks right now, just with how crazy the inflation of the pricing on single family and commercial multifamily has gotten. Not to say that it hasn't trickled down into mobile homes, but yeah, you can certainly buy those kind of real estate assets as well. Tax deeds, REITs. REITs definitely aren't the most typically thing that we see here because they more or less that more often than not, they're going to be capitalized REITs and sold on an exchange market that you could use someone like Fidelity or TD Ameritrade to buy. If you want to buy into a private REIT, though, we can certainly facilitate that. But again, not something super common. And again, when we're talking about this, when we're talking about buying real estate, we're talking about buying it directly. So not through a REIT. Your IRA actually owns a piece of real estate, owns the piece of real estate. And let's say you want to be more of a passive investor, you don't want to have the overhead, let's say, of directly investing into a property with tenants and toilets. You can invest in syndication. So you can invest in commercial properties, multifamily, limited partnerships, LLCs, all that kind of good stuff can be done through IRAs as well. So buying the real estate, and we're going to get into this, excuse me, in the case studies as well, but on, again, a very high level to kind of get you prepped for what we're going to be talking about. The IRA actually buys the property, and we'll get into some structuring with entities as well, but the property is going to be purchased in the name of the IRA. So everything from the contract all the way through to the deed, settlement statement, prorations, estoppels, title policies, everything's in the name of your IRA. You're personally not buying this property. The IRA, in a legal sense, is as different of an entity as I am from Larissa and by extension, all of you. Even though it is your retirement account, you have to kind of understand the basics of the fact that there is a separation on a legal structural level between yourself and your IRA. That's definitely going to help you understand kind of the closing process. The biggest issue that I see a lot of people run into, and especially when I was doing transactions for clients, is that I would get a contract signed that had a closing date 4 days in advance. It'd be in the client's personal name, and they'd be like, look, we're closing in 4 days. Here's a signed contract. Let's go ahead and do it. Well, unfortunately, that's going to cause a lot of scrambling at the last moment because just like I've enumerated up here, everything, again, from contracts, settlement statements, deeds has to be in the name of the IRA, and we at Advanta have to sign it if you're closing directly through the IRA. So if you're interested in doing this, the sooner you get your IRA administrator involved, the easier things run. But on a general construct, not to get too far into the weeds, is that you need to make sure that the property is properly titled from the beginning. So Advanta IRA for benefit of client name, IRA number on the contract, we sign the contract, settlement statements, you approve the deed, ultimately we fund at closing. All funds for the purchase have to come from the IRA. If the IRA is named as the sole buyer on a piece of real estate, IRA's got to fund the whole deal. If it doesn't have enough cash, it might need to bring in partners that need to be listed on the deal. That can either be done on the deed directly or through an LLC or something, or you can borrow the money. A lot of different ways to do it, but understanding that you can't float the additional expense for your IRA is a good guiding principle to think of with this. And again, purchases can be made with yourself and others. And all of the income from the property has to go back directly to the IRA if it's the sole owner, or be split along the exact lines of capital contribution into the deal that all the other partners have. So things like rent, profits, all that kind of stuff goes back. And whatever portion of the deal your IRA is involved in is completely tax-free. And it doesn't matter if you have a Roth or traditional simple 401k. Any income that comes in during the life cycle of the investment is completely exempted from taxes because your IRA is not filing a tax return. It doesn't flow through to your personal income statement. It's pretty easy from that regard. Now, if you do have debt financing on the property, you borrowed money, you might have to file a tax return, so it can complicate things a touch. I've got a couple questions. Let's knock those out. I have purchased property with 90% IRA and 10% personal funds. I think I might be in context. I'm not sure what this is in context to, but you could certainly do that. Everything would be split 90-10 with regard to expenses and income, so it doesn't particularly cause an issue. Let's see. One person asked, so the LLC would be the owner of the LLC. I think you meant to say, so the IRA would be the owner of the LLC. That is correct. Can you use IRA funds to rent space for a specific purpose for a limited time? For example, if you utilize a venue for activities for a very short period of time through a rental agreement with that venue or facility, can you use your IRA for the rental agreement? Yeah, you could do some type, your IRA could certainly enter into some type of rental agreement for some type of space. The problem is you couldn't personally use it. So if you wanted to do some type of, like, let's say a master lease where you would get a lease and then be able to lease the property out on the secondary market and make your money on the spread between the underlying rent that you're paying for it and the rent that's coming in. Yeah, we have clients that do that all the time. But if you want to personally use that property for something, the IRA couldn't be the leaseholder or the like for it. Let's see. If the client is the realtor, can they perform the sale and apply the realtor commission to the IRA? Nah, it's a little bit of a case-by-case question with that. I tell most people, if you're a realtor, negotiate what you would take in commission as a discount on the property. Ultimately, you always need to make sure that you are staying abreast of any correct IRS rules. If you feel uncomfortable with a potentially, let's call it a little bit of a gray area, which acting as a realtor and representation in an IRA definitely can be, getting into a few gray areas, paying for a few $100 of an attorney's time to look at something and give it the go ahead, probably not the worst use of a couple $100. I personally can think of things I've spent that are much less beneficial uses of several $100. So that takes care of the questions. Let's keep on rolling. So expenses in rentals and rehabs. With either strategy, expenses are paid by the IRA. So the way that works is that you submit a copy of the invoice to Advanta, or you can use your online portal here to request a bill payment. Super easy, but we're the ones that need to pay any and all expenses for the property. So in the context of what one of the people asked earlier is that, hey, can I use 90% IRA funds and 10% personal? Well, sure. But if that 90% from the IRA represents all of the IRA funds, and let's say it's a rehab project, well, you're going to need to adjust those percentages a little bit because the IRA is going to be responsible for 90% of all of the expenses as well, and you're only responsible for 10. You can't float those costs. So understanding that the IRA is responsible for expenses, not only just due to the profits from the deal it's in, is important to understand. So if your IRA has, let's say, $100,000 in it, and it's rehabs you're looking for the $95,000 property that needs $10,000 worth of work, not going to work really well in that scenario. I would tell people, make sure you have a good buffer, because if you bust down a wall and you find that it has old, I can't remember what the type of plumbing is, that's the brittle plastic. Let's say you find that in a property and you got to replace that. You need to have a buffer, because if the unexpected happens, which, let's be honest, when it comes to real estate, you're always going to find stuff that's going to go not according to plan. And real estate projects are typically not something that you're going to say, wow, that came in way under budget. Making sure you have those kind of buffers in place when it comes to how much of your IRA funds you're using is very good for making sure that you don't run into unexpected problems in the future. And I'll kind of get into how that might play out in a little bit. Again, there's no limit of number of bills that the IRA pays, and these are not considered distributions. So it's just considered expenses related to the asset. So everything is just paid from the IRA. Again, this is not hitting your personal income tax statement. And again, remember that the IRA has to pay all expenses related to the property insofar as the percentage of the deal that it owns. So think of things, maybe just past a rehab project or a rental that you would normally see, things like property taxes, insurance. All those things have to be paid from by the IRA. So understanding that going into it with both feet forward and both eyes open is very important. And it's one of those things that we really want to make sure people understand, is that if your IRA has 100 grand, purchasing that $98,000 property, while yes, on face value, after closing and everything, the IRA could afford it, you got to pay taxes, you got to pay for insurance, all that kind of stuff that every other property needs when you invest in real estate, definitely is still going to hold true here with that as well. And with regard to income, question asked before I hand it off to Larissa here in a moment, do profits just go back into the IRA? Well, I wouldn't necessarily say profits is the best use of context for that. I would say income. So any income from the property. So whether that's rent, whether that is the total due to seller on the settlement statement, that's what's going back. Whether or not it is a profit is kind of irrelevant. It's hopefully you're making a profit. I hope all my clients make profits, but it's not just the profits that go back in. It's income is really kind of the best way to describe that. And just leave. Yeah, so I'll turn it over to Larissa for going through the benefits of rehabs. Larissa, you take it from here.
Okay, great. Thanks, Alex. And since it did come up quite a few times, partnering IRA money with non-IRA partners, we do have a webinar coming up. And so if you guys are interested in learning about the different structures we see when you're partnering qualified funds or IRA money with non-IRA partners, that will be coming up in July. So you could go to advantaira.com/events and register for that webinar. And we'll be talking about it just partnering directly through the IRA and then with maybe personal funds or personal funds of a partner. We'll also talk about LLCs. We'll also talk about property managers and different ways to make those types of partnerships a little bit easier. So that will be in July, and you can go to advantaira.com/events. So we're going to start off talking about rehab. So we're definitely looking at two different strategies here. And of course, you certainly could purchase a property that you plan on holding long term and do some renovations to it. But more specifically, we're talking about the profits from the sale of the property once you've rehabbed it, and then having those profits go back to the IRA so that you can start again with that same strategy. So when you're purchasing a rehab property, the property money it can be sold, and then the money can be immediately reinvested into the next investment. And so when you're looking at something through an IRA, we're not talking about a 1031. So a lot of times people say, well, if I purchase a property now and I sell it in a year, do I have to get a 1031 intermediary for those funds while I look for the next property? And capital gains do not apply to the IRA. And so that's something that you want to keep in mind. There's no requirement that you hold a property a year and a day to avoid capital gains taxes. And so when you're looking at the strategy that you're going to utilize, that might be something to consider. Now, I do want to note here that it is possible, depending on the number of rehabs you plan on doing and what also you do outside of the IRA for a living, as to whether or not that tax Alex mentioned at the beginning, UBIT, may or may not apply. So just keep that in mind, make a note, and talk to your CPA. That does fall under tax advice that we cannot give, but just keeping in mind that if you're planning on doing rehab projects through your IRA, talking to your CPA about possibly the number of rehabs that you can do before UBIT may or may not apply to that investment. So again, basically keeping in mind that capital gains don't apply to the IRA. And so if you purchase a property today and you rehab it in 6 months and you sell it, and you turn around and sell it, you don't have to use a 1031 intermediary. The IRA is almost like an intermediary, where your profits and the principal that you put into the property comes back to the IRA, and then you're ready for a new investment. Just keeping in mind that expenses and profits, or as Alex said, income, does flow through the retirement account. So when you go to purchase this property, just as with a rental, everything from contract to close comes from the IRA. Any expenses paid are going to come from the IRA, and then any income or profits are going to go back to the IRA, and then you're ready to make the next investment. And just keeping in mind that if you do this directly through the retirement account, the IRA is going to pay the expenses, but Advanta IRA doesn't really have a limit on checks. For example, the IRA doesn't have a limit per IRS rules on the number of checks that can be written to rehab a property. And so basically what you're going to do is go onto your online portal and request any checks that you need to pay your contractors and vendors for the rehab of that project. Now, there are drawbacks to a rehab, and so pros and cons always with looking at your investment strategy. But because all expenses must be paid by IRA funds, you might be limited on the scale of the project that you can do. So as Alex said, you want to look at it and kind of have a crystal ball and say, okay, well, if I have $150,000 in my IRA and it's going to cost me $100,000 to purchase the property, is that $50,000 remaining going to be enough to do the rehab that I want to do on this project? Or do I have to bring in a partner? Do I have to partner IRA funds? Do I have to bring in a non-IRA partner? Am I going to be borrowing funds for this project, or will that 50,000 really be more than enough to cover the scale of the rehab that I'm looking at? Also, since IRAs don't typically file tax returns, and again, in some cases they will, those expenses to that investment cannot be written off your personal taxes. So a lot of times people will say to us, well, maybe I don't want to invest in real estate by purchasing real estate because I don't get the write-offs that I would if I did that personally. And so you might look to a different strategy for your retirement account. If during the project the IRA runs out of funds, again, having that crystal ball and looking at what that's going to look like for this project. And so if you have enough money, if you're confident that you're not going to go over, or if you're leaving an amount in the retirement account in case the project does go over, then that might work for you. But if you have to look at it at the end of the project and say you're short $10,000, where will the IRA get that $10,000? And keeping in mind that that at this point cannot be personal funds unless you're eligible to make a contribution, and you can make a contribution within the limits that the IRS gives us each year, and that will work for the remainder of the rehab project, then that would be okay. But outside of that, you couldn't just say, well, I'm going to add personal funds to this now at this point, because the IRA owns that, and that would be considered prohibited. So keeping in mind that your IRA is almost like your business partner. And so if your business partner buys 100% of the property, then your business partner is responsible for all of the expenses and will receive all of the income. And again, maybe you could have partnered with your IRA at the outset, but that could potentially be a gray area, and looking at the current personal benefit might be something that you wanted to go over with an attorney to make sure that that is properly structured. And again, remembering that you cannot do any of the work, swing a hammer, provide any sweat equity for the property or the investment yourself, and that also includes disqualified third parties. So if you're going to buy the property and you don't plan on doing any of the work, but for example, your son owns is a contractor and owns a business, and you'd like to hire him to do the work on the property, remember that that would be considered prohibited. Even if he's not out there doing the work physically himself, but sending out his guys and pulling permits and so on and so forth for that property, that would be considered prohibited. So make sure that you're hiring all what we call non-disqualified third parties to do the work. That could be painting and landscaping and laying floors. And the IRS doesn't have any requirement that this individual is a general contractor. So if you're looking to individuals to do the painting and so on, you certainly can do that. But again, making sure that they're unrelated to you and they're not considered a disqualified party when it comes to your IRA. That's very important. We had some questions pop up, so I want to go through these very quickly. If you are retired and can you contribute additional money to your self-directed IRA? And the answer is, it depends. You do have to have earned income. So you might be retired, but maybe you have a side hustle or you do some consulting or something like that. You have to have what the IRS considers earned income in order to contribute. And then you're going to be limited to your contribution based on either the amount you earned for the year or the limit with the lesser of the two. So if you only had $3,000 in earnings and potentially you can contribute all the way up to 7,000, well, you're going to be limited to that 3,000 because you had only 3,000 in earned income. So I hope that answers your question there. What happens if you want to get cash out from the self-directed IRA? So really, that's just a distribution. And so as long as you're over the age of 59 and a half and you have cash in the account that you would like to distribute, you certainly can do that. So in the context, for example, of a rehab, if you purchase a property, rehab it, and sell it, and you have all that money go back to your IRA, but you would like to take some of those profits or some of that income from the retirement account, that is just simply a distribution. You complete a form, you fill out a form with Advanta IRA, request the funds, and then it is distributed to you without penalty as long as you're over age 59 and a half, and taxed as ordinary income if it's a pre-tax account, or as long as your Roth account has been established for a minimum of 5 years, then it's distributed tax-free. Let's see, but can't Add to their IRA each year. Yes, you can add to your IRA again based on the contribution limits on your account and as long as you have earned income. I see Alex answered some of these directly, so I'm going to skip over those, but I will go up to make sure I answer these. Somebody caught a typo. Thank you for that. Will my LLC be disqualified for the build? I'm assuming you mean that your personal LLC is maybe a general contractor or you're involved in that business, and can the LLC then be involved in the build with the purchase through the IRA? Yes, it would be prohibited to use yourself or a company that you own or you own 50% or greater or have a controlling interest in to do the work on an IRA owned asset, and that includes building. Okay, we're going to go on. And so I think, Alex, is this still mine? Yes, it is. Okay. So with long-term investments, we're going to talk now in contrast about rentals. So buying and holding a property. And again, you may purchase a property and see that it maybe needs a little bit of work and you're going to do some rehab work on it. But the purpose of this investment strategy might be to hold it for 2 years, 3 years, 5 years, 10 years, 30 years, whatever that investment strategy is, you're looking at a long-term hold. And typically with an IRA, we see people purchase, they're going to hold long-term, and they usually put long-term tenants in place. And we talk a little bit about short-term versus long-term tenants here, but typically we're talking about a buy and hold with long-term tenants. And so the IRA holder is going to determine the strategy for growth for their retirement account. So if you're going to purchase a property, we're not going to tell you, okay, well, this property has to be rehabbed and then you have to sell it, or we're not going to say you have to rehab this property and do X amount of work before you put a tenant in place. All of these points are going to be determined by the IRA holder. And so I always like to say that we hold the account, you find the investment, you determine the strategy, and then we help you get it done in the name of the IRA. And that's what a self-directed retirement account really truly is. And so just remembering also that when you're investing through the retirement account, again, it's not a loan, it's an investment in the account. So just as you would hold stocks, bonds, and mutual funds, your IRA in this case would actually purchase and hold the rental property. And so how does this work? How do you manage the property? A lot of people say, well, I can't be the property manager. Is that correct? And so instead of saying that you're going to be managing the property, we like to see that you're overseeing the property. What that means is that you're not going to do the work on the property. You're not going to go out and provide those services. Again, no sweat equity on this, just as we talked about for rehabs. You can't do that with rental properties either. You don't want to be mowing the grass, or you don't want to go out and say, well, I really think the front door should be painted red. You can't perform that work yourself. But again, hiring individuals that are non-disqualified, unrelated parties to you to do that work on those properties, that would certainly be okay. But you are going to determine who you're going to rent the property to. So we are not a property management company. We're not going to say, okay, well, we'll place a tenant for you. That is going to be your job. And if you employ a professional to find a tenant for you, that expense would be paid by the IRA. You don't want to take any direct receipt of rental income. So if your tenant hands you over a check, that check should be made payable to the retirement account. That's very important. So you might go and collect the rent to make sure that your tenants are paying on time, but that check is from the time you pick it up is made payable to your IRA account and then deposited with us at Advanta. And expenses are paid by the retirement account. So you're not writing a personal check to have somebody mow the lawn, for example. You would go to your online portal, request a check from Advanta. We could send you the check, but it will be made payable to the vendor that you're going to be paying, and then you could certainly deliver the check, or we can send it directly to your vendor. You're going to let us know. So very important, the flow of funds directly through the retirement account in and out of the IRA directly, but certainly you can hire those vendors. You're going to let us know who we're paying. You decide who you're going to put into that property and how long the lease is going to be, and that's going to be very important. You can also hire a third-party property management company if you would like to do that. Again, it can't be a property management company that you own or have controlling ownership in. You want to hire all non-disqualified third parties. You can let us know what the agreement between you and the property management company is. If they need additional funds, for example, to pay an expense for that property, you would let us know. We could send them the money and then they could pay for that expense. They would collect the rent for you and then ultimately send the rental income over to Advanta for benefit of your account. We would deposit those to your retirement account. A lot of times people will say to us, well, can our tenants just send checks directly to Advanta? And we certainly do, from the 1st to the 5th, we receive rental checks, we receive payments on mortgages, investment income of all kinds directly to the IRA. But again, because we're not a property management company, we are not keeping track of when that rental income is received. And so if you're looking to make sure that your tenants and your borrowers are paying on time, then that might be something to consider. If you say, well, I don't want the tenant sending the checks to me, I don't want to go and collect them, then you might look to a third-party property management company for that service. And I'll give you a perfect example. Coming up this weekend is the 4th of July, and so we have a federal holiday on Monday. And so very important, when rent checks are sent to our office from Friday to Saturday, that we're not going to be logging when those checks have been received. On Tuesday, when we get back to the office, they will simply be deposited. And so if you called and said, well, I want to make sure that my tenant sent that check on the 1st, did you receive it on Friday? We really won't have any record of when that check has been received. So again, if you're looking to know when that was received directly, a property management company might be the solution for you in that case. Again, the IRA holder is negotiating all the terms of the lease, but then Advanta IRA will actually sign the lease on behalf of the IRA, because remembering that we are the official and legal signers for your retirement account. And so you would send a copy of the lease to us. We would execute it on behalf of the IRA and send a copy out to all parties. We're going to go through a case study here. I do see that we had some questions pop up, and so we're going to just go through a few of these questions quickly before we give you an example of purchasing rental real estate through the IRA. Are expenses related to finding tenants paid by the IRA? Yes, that is very important. Again, if there's activity or expenses for finding tenants for their retirement account owned rental property, you want to make sure that the IRA is paying those expenses. So for example, if you hire a property management company to do a one-time tenant placement, for example, you want to make sure that the IRA is going to be paying that expense. Oversight activity to find renters allowed. Now, this goes back to sort of making a determination for yourself as to whether or not that might be considered a gray area, or if this is providing a service to the IRA. And this is where Advanta really won't advise you as to whether or not, finding the renters, placing ads, for example. Anything that you do should be paid by the IRA, but whether or not you feel like that's providing a service to the retirement account, we're going to leave that up to you and to determine. And again, if you feel like you need a legal opinion on that, we certainly can provide information for attorneys that can help you with that one. There's an example listed here for a question. I have purchased a rental property and the person is paying $1,000 a month for rent. There's a repair that needs to be done. It costs $300. Now I only charge $700 to the tenant for doing the repair. Is that allowed? Yes, certainly. That is, again, between you and the tenant. And if you have some sort of agreement in there with your tenant that, for example, they're going to pay the first $100 of any repair, but you would take the remainder of that repair off the rent, again, completely up to you, between you and the tenant. This is being recorded, and the recording will go out to all people who registered by email. It's usually the next day, so you will see that recording. Lawsuits handled by the IRA. Yes, so if you had to hire an attorney, for example, for some issue with a tenant, including eviction, that expense needs to be paid by the retirement account. This is jumping around. Give me just a second here. If I'm creating an LLC for my self-directed IRA, how should the expenses for creating the LLC be handled? Yes, that should be paid by the retirement account. And a lot of times you can have the attorney just send us an invoice for creating and registering the LLC, and we'll make sure to help you have the IRA pay that directly. Is a CPA also paid by the IRA? It depends on the services. If you want to reach out to us directly, if you have to hire a CPA, for example, to file the 990T for your UBIT tax that maybe your IRA incurred, then certainly the CPA would be paid by the retirement account. We're going to go on in just a second. There are a few more questions up here, and we certainly will get to those questions as we go. But as Alex said, we'd like to respect the time of all attendees and try to finish with the main part of the webinar right at the top of the hour. So we're going to look at a case study for purchasing rental real estate in a retirement account now. And in this example, the IRA holder or owner only holds this property for 2 years. But as I said, you could be looking at holding this for 2 years, 5 years, 10 years, or 30 years, or maybe you just don't have plans on when you're looking at selling the property. And again, as a self-directed IRA holder, those strategies are all based on what you want to do, because this is truly a self-directed retirement account. So in our example, John wants to use some of an old 401k to purchase a rental property down the street from his property. How does this work? What does John do? What does Advanta IRA do? And so John is going to open and fund his IRA account because it's coming from an old employer plan. It's going to be considered a direct rollover from the IRA. He's going to find the property, make an offer to purchase, and Advanta IRA will sign everything from all of the offers through to contract to close. That's very important. We are the official signers, and we're going to make sure we're going to review the purchase documents, the contract, everything, to make sure that the IRA is properly represented and the IRA is going to show up on title. So basically, Advanta IRA for benefit of John's IRA number 1234. We're going to have John read and approve all documents as it pertains to the retirement account, so purchase documents and everything. He'll read and approve those through DocuSign. Once he does that, then Advanta will handle the closing on his behalf, and on behalf of his IRA, sign all documents and wire funds for closing. In this strategy, John holds the property for 2 years, and once he has decided to sell it, he will let Advanta know. He places the property for sale. He pays all of the expenses related to the sale through the IRA. All of the money, including the profits, are going to go back to the retirement account, and now John is ready to make his next investment. And this is just a very simple example. There's no financing in place. John purchased the property with all cash. He paid for any expenses all through cash in his retirement account, received the income directly through the IRA account, and his investment, again, directly through the retirement account. If you're looking at different strategies for making these investments, including partnering, again, check out our webinar that will be coming up in July, where we're going to be talking about different strategies, and that will be included. I see another question that popped up here, so I'm going to check those out before I turn this back over to Alex. If someone is turning 72 and they have an RMD, can RMD to be transferred to the holder's percentage of the IRA to pay the taxes? I think what you're asking is if they have an RMD. So basically, if you have an RMD, which is a required minimum distribution each year after the age of 72, can you use that RMD to pay the taxes? That would not be the IRA paying the expense. That would be first taking a distribution. And so no, basically the IRA has to pay that directly, and that would not be considered a part of your required minimum distribution calculation. So those two are going to be considered completely separate.
Oh, right. Go ahead.
Yeah, one more question. Can a realtor IRA holder post the property for rent or sale on the MLS? Again, that might be considered providing services to the IRA. And so if you're looking for a legal opinion on that, we certainly can direct you to an attorney that could help you decide whether or not that would be considered providing services. You could certainly always look to a realtor friend and pay them some nominal fee from the retirement account in order to have that rent or sale posted for you. And with that, I'm going to turn it over to Alex.
Great, thanks, Larissa. Yeah, like I said, we'll try to get through this as quickly as possible. I know people, typically schedule their lunch to do these things, so we'll try to respect your time. So in this case, partnering on a real estate flip. Again, most of the context of these things are going to hold true with regard to expenses being paid, like Larissa mentioned, who can do the work and who can't. So we can kind of transplant that, and just for your understanding of that, again, remember, all expenses need to be paid by the IRAs. So in this case, they decide to partner on a rehab project. Paul and Linda want to partner it. So they have $100,000 in their IRAs, and they find a property for $150,000. It's going to need $20,000 in repairs to get it ready to sell. So in this case, they're going to bring their IRAs together because neither one of them have enough money in their IRA directly to purchase the real estate. So they're going to come together. Now, this can be done through an LLC where they form a new LLC, and both IRAs are going to be named as member of the LLC, and their percentages of interest are going to be based on how much money they contribute, or they can both be on title directly. So they go out and they find the property for 150. Again, he's about $20,000 in repairs. So they both decide to put in their IRAs into this. Again, they can determine how much percentage they each want to have. But remember, any and all expenses are going to be split along those percentages of ownership, and all profits or sale proceeds are going to go back into that as well. So they estimate receiving profits of about $10,000 to $20,000 after the property sells, which was going to be split between the IRAs tax-free. So again, any and all profits, whether it's going to be rent or rehab, is going to come directly back into the IRAs tax exempt. It doesn't matter if it's a Roth IRA, traditional IRA, or anything. They get the benefit of it being within the tax shelter and immediately being able to take those funds and then reinvest them down the road. So partnering, again, you can do this on a flip. You can do this on a rental project. And just remembering those rules like Larissa mentioned of how those expenses are going to be chopped up and paid is going to apply in this context as well. So who does what? Paul and Linda need to open and fund their IRA account. So they open it, they elect to have everything moved over from their other IRA custodian, and then they're going to make the offer to purchase the property, submit the Advanta IRA paperwork, and read and approve all documents. Advanta, we're going to work with the closing agent to ensure proper titling on all documents, that we sign everything correctly on behalf of the IRAs, that the funds are wired out in a correct manner, and then receive and store all the completed closing documents after closing. And then some other considerations, the deed will be titled between the two IRAs if they are going to be splitting it up on the deed. Again, you can use an LLC, and I'll show you how that goes in a second. Expenses are going to be split along the percentages of ownership. So any rehab costs, if it needs a new roof, if it needs no electrical, everything's going to be split. And in this case, if it's 50-50, Paul's IRA and Linda's IRA are both going to have to kick in a check for their percentage of this. Each IRA will share in the income and expenses, and the percentage of ownership and between the two of them cannot change if they're disqualified persons. So if it's anyone in that directly relatable family tree, you can't have the percentages change. So if one person runs out of money, maybe they didn't have a whole lot between the two of them, and one of them was a little bit thinner and the one had more money, you can't change or buy and sell those percentages if it is a disqualified individual partnership. Let's see. So questions to make sure we get through those. Now, a lot of people say, well, I like to structure this through an LLC. How does that necessarily work? A lot of people like to call that checkbook control. And there's a few differences that need to be understood between checkbook control with an IRA versus non-checkbook control. So doing it directly just through the custodian. The custodial administrator account means that the administrator, Advanta, is going to retain all uninvested cash, pay all the bills at the direction of the client, and administer and receive all income and deposits, whether that's the sale proceeds, rental income, the like. With checkbook control, the client's going to be taking over a little bit more of that administrative responsibility because the IRA is going to directly own an LLC that in turn will then distribute and own the property for the IRA directly. The issue with that, though, being that the client is going to be more responsible for all record keeping and any other details related to the IRA on property, whereas Advanta is going to be record keeping bills, closing documents, the like. So if you don't have a penchant for being able to save receipts and do record keeping, having us do it's definitely going to simplify your life. If you don't mind taking on that responsibility, a checkbook control scenario might be a good thing for you. Or if you're looking to partner IRA funds with other people or maybe a larger group, checkbook control can also be a very good method to go through. Now, how exactly does this look? So in this case, Rachel wants to buy a very intensive rehab project with her IRA and needs to be able to issue checks and payments immediately for contractors, etc. So checkbook control and LLCs by extension work well for rehab intensive projects. Maybe not necessarily a rental project because after closing, maybe you need to pay a few bills, expenses, insurance, taxes. Those are pretty easy to handle through an online portal. But if you need to go out, make sure work is done, write a check for contractors, things like that, having things flow through an LLC might serve to potentially make your life a little bit easier. So in this case, the IRA directly is not going to be buying real estate. We're going to be focused on the LLC. So the IRA is going to become a member of the LLC newly formed LLC. So in this case, instead of providing us with closing documents and contracts, the client's going to open up the self-directed IRA. Rachel's going to go out and form the LLC for the IRA to own. This is the checkbook control, making sure that the membership is correctly titled Advanta IRA for benefit of Rachel IRA number, and then ultimately is going to close on the property in the name of the LLC. So instead of the public record deed having Advanta IRA on it, it's going to have Rachel Sunshine LLC on the title of that deed. Then from there, what does Advanta do? So we again facilitate the rollover and transfer of funds from the external IRA custodian or old 401k, thrift savings, 457, 403b, etc. That's always the first step in the process for us. Then from there, we're going to be reviewing an operating agreement for the IRA. So the IRA being named as the member of an LLC, that's what we're concerned with. Once we reviewed the IRA vesting on the LLC operating agreement and Rachel has opened up the business checking account for that LLC, we'll fund the operating account of the LLC with the funds from the IRA once all of the paperwork is completed. And then from there, Rachel's going to be the one that's going to be writing all the checks, administering all of the assets, paying for contractors, collecting all the sale proceeds when it sells into that LLC bank account, and going forward from there. So the pros, you have quick access to IRAs for auctions, rehab projects, everything else like that. You have some possible asset protection and anonymity. It's potentially easier to make investments with partners, and you can hold real estate, notes, brokerage accounts, everything in the same entity. However, you are responsible for accurate records. You do have a little bit of less oversight from the administrator. It can be potential to engage in prohibited transactions, and additional capital contributions could be problematic if they're partners. This is a class that we teach a whole hour-long course on, so please don't feel like you need to get everything in one snap. But that's kind of, again, the general overview. I know we're running a little bit out on time, so we'll kind of try to end it here, answer any additional questions that you might have. But we want everyone to know that we hold bi-weekly events. We have a great video library of everything cataloged. We also do have a blog that we maintain. We have a podcast that releases every Wednesday, and our Pitch, Promote, and Prosper pitch call that we hold every other Friday as well. If you're looking to get started, it's easy to open the account. You just need to contact Larissa and I. We can help through the whole process. And again, getting started with investing is as easy as once you have the account open, then we can have everything done for you in whichever manner that you would like to move forward with. With that said, we'll answer any questions. Thanks again, everyone, for joining with us today. We really enjoy having the good engagement, getting your questions answered, and providing you with this great content.
Yes, and I think we did get all the questions answered. I appreciate you guys hanging in there with us. I know we're over a little bit. We did have a lot of questions, which we do love to get questions. It really makes the webinar more personalized for the attendees. So I think with that, we can close this. Thank you so much, Alex, for presenting with me today, and I will see you soon.
Thank you very much, Larissa.